Hey there. Thanks for listening to this episode of the Coffee and Technology Podcast brought to you by Cropster. In this episode, we speak with Albert Scalla. Albert is a Senior Vice President of Trading at StoneX. StoneX is a financial services company and is among one of the largest commission commodity trading houses in the world. Albert's expertise spans across commodity brokerage and the commodity futures markets. Albert brings a wealth of financial knowledge into the coffee industry and has spent a significant amount of time educating coffee professionals around the world on futures trading and hedging in coffee. Enjoy as Albert discusses market volatility and the recent market effects of Brazil's frosts. Albert, welcome to our podcast. It's super exciting to have you here. Me and Norbert have been itching to get this conversation with you started, so it's a pleasure to have you here. How's it going?
Well, thank you, Norbert and Nicholas. Thank you for the invitation. Pleasure to join you. And it's always a pleasure, and it's always part of our interest at the company at StoneX to assist in any way possible, especially when we're dealing with the actual physical commodity, its traders, its stakeholders in the entire commercial chain.
Yeah, no, for sure. So just really quick to maybe just get things started, if you can maybe give us a brief background of who you are and your work at StoneX, I think that will set us up for what's going to be a really interesting conversation.
Okay, well, my name is Albert Scalla. I'm now a Senior Vice President of Trading here at StoneX. StoneX is today one of the largest commission commodity houses. We've been growing quite fast over the past several years. However, in the last 2 years, we've seen an explosion of our growth. We just hit number 58 in the Fortune 100 companies. We hit number 37 in the fastest growing companies, and we've grown from number 383 in the Fortune Global 500 to number 190. And it's all been because of the explosion of what's happened over the last 2 years in market volatility, commodities, the stock market, the exchange rates, personal investment, finances. And it's all of this is tied into the volatility of prices of all commodity, of all products, from shipping to coffee prices. And it's been a slew of different things. And what I do, I'm a commodities broker, just like a stock broker, but our expertise are in the commodity, the futures markets. If you want to see the value of a share of, Apple. So you go to the stock market and you see where Apple shares are trading. However, if you want to see where crude oil, if you want to see where soybean prices are trading or coffee prices, then you look at the futures exchanges. And each exchange specializes in particular commodities. And if you want to trade coffee, you have to look at the New York Intercontinental Exchange or the London Intercontinental Exchange and see where Robusta coffee prices are trading and where New York Arabica prices are trading. And my job in its basic form is to assist anyone from the tree to the cup, anyone in between, to be able to transfer risk. So, Nicholas, let's say you're a producer. Well, you've got price volatility. You've got risk. You've got probably a harvest, a crop on the trees that you need to harvest. But you don't harvest until November. But prices are attractive today. But your coffee's not ready until November. So you don't want to wait until November to harvest your crop and then ask, where's the market? And now the market is much lower. So the futures exchange and a commodity broker like myself, what we do is assist producers like yourself to say, okay, prices are high now. Your crop doesn't come in until October, November. Okay, let's take advantage of the futures exchange so I can secure my December prices. So you sell today for something you're going to deliver in 3 months. And that's a basic operation of a hedge.
Mm-hmm. What happens if I cannot deliver? Because of
this is it. Because the weather.
Yeah.
Right. So the mechanics is Nicholas saw the prices, they're attractive, so he sells today December delivery coffee. In the futures exchange, let's say that next month he's got problems with the weather and he doesn't seem that he's going to be able to harvest. The attractive part of the futures exchange is that you're not locked into that price. Let's say next month you see that the production is going down, Nicholas can cancel that contract. They can eliminate. They can liquidate that contract. So he sold it, let's say, at $1.80, and next month he sees that it's not coming in. He can come in, call his broker, and say, you know what, I don't have the coffee coming in, liquidate. So he sold it at $1.80. He just in a month sees where the price is. It may be lower, it may be higher. He just liquidates the contract. 99.5% of all the contracts traded in the exchange do not end up in delivery, in the physical delivery to the exchange. It is a mechanism for the producer, the roaster, the importer to protect the inventory until they make the delivery to their typical buyers. They don't deliver to the exchange. So Nicholas contracts with Norbert, their coffee roasters. So Norbert fixes his price wherever it's attractive. Nicholas protects. They both going to deliver to each other, but in the meantime, they park the risk via the futures price exchange in each exchange.
So Albert, who can participate?
Anybody. Here's the limitations, because it's not anybody. You do have limitations because you do need to have some financial backing. What does it take to open an account? It's just like if you want to write a check, if you want to send a wire transfer, well, you need to have a futures account in order to hedge. So there's two basic types of accounts. One is a basic futures account, and really there's no minimum to open that account. Anybody can open it under the farm's name or under your personal name. Each individual, you could be an individual farmer without having an actual company. You can open it under your individual name or a company name. And you do have to meet the margin requirements and collaterals that the exchange requires. So if you're a roaster or if you're a producer or anybody in between, if you want to buy a futures contract, which is 17 tons of Arabica or 284 bags of 60 kilogram bags, 37,500 pounds, whichever way you want to look at it. The exchange requires today to put a collateral of $9,000.
That's for buyers.
And that's for everybody.
For everybody.
Okay. Yeah. So if you're buying, you're going to be buying a futures contract. If Nicholas is a producer, he's going to be selling a futures contract. Each participant for every contract, they need to put a collateral today of $9,000. The day that you liquidate the contract, the exchange returns the collateral to you.
Okay.
And the only thing that you have to maintain as well is, let's say you're the roaster, you bought it at $1.80. If the market comes down to $1.75, you also have to put that difference in cash to the account. If you sold it, if Nick sold it and the market goes up, Nick has to put the balance, the difference. And that's the way that the exchange guarantees that every participant meets their obligations with what's called initial deposit, initial margin, and the daily variance, whether it's up or down. And at the end, anytime that the customer decides to get out of the contract, the exchange returns that initial deposit back to you. And the only thing that's left is where you bought it and where you sold it.
This is super interesting to me, just because it's like, so in college, I took a money and banking class, and this is everything we talked about in the textbook, literally. Yeah. But now it's interesting hearing it from you, because it's coming now from an industry that I actually work in, which is even more fascinating. So it makes me feel like that class didn't go to waste. But let me ask you this. So let's just dive deep into it. What is the level of accessibility of these accounts for, let's say, producers or those in origin who are remote in the middle of nowhere and have very limited technological access? Where does, for example, StoneX come in and say, these things are accessible to you?
Well, we've come a long way, Nicholas. When I first started in this business 30 years ago, it was, I think I was at the tail end of telex machines. Okay, so that was pretty bad. Then we started getting these thing called faxes. All right, pretty much obsolete. I still see whenever I do a banking or whatever, they say, "What's your fax number?" And I go, "Do they still exist?" Or floppy disk. Okay, that's another one.
Floppy disk. There we go.
Floppy disk. Back in 1994, the last major frost we didn't have iPhones. We didn't have people taking, pictures on their iPhones on the farms and sending via email. Email barely started. So you can see the difference where we've come from 1994, the last major freeze, to, this year's major freeze. Today, by the time the sun was rising, everybody was flowing hundreds of pictures taken from the farm, videos, up to the second. And the same thing has happened with the access to the financial markets. We have small producers in the Andes of South America. We have small producers in Central America. It's hard to find someone without a smartphone nowadays. And you go to many of the farms up in the mountains in Peru, in Colombia, in Central America, in Brazil. Just about everybody has access to a smartphone, or there's internet cafes. So the information today, it's at another level. What do you need to have the access to the market? Basically, you need to be able to have a bank account where you can send wire transfers, because if you want to trade a futures, you need to have a bank account, because you need to wire money to your account in the United States or in London, where the two main exchanges are. So the first thing the customer needs to do is open a futures account with a commission house. And you want to look for a commission house that has a good reputation and that has a team that specializes in the product that you want to trade. So, for example, if you're a corn farmer, you want to go with a company that has some experience in the corn activities. Or if you're in coffee, you want to look for a commission house, whether it's StoneX or anyone else, that has a team that is dedicated to coffee and can help you with all the intricacies of trading coffee futures, options, and structured products. You open an account very similar to opening a bank account. They're going to ask name, ID, pictures. If it's a company, they're going to want to see your financial statements or to see the corporate documents, the articles of incorporation, or each country has a different legal. So that's the limitation. Having a bank account that you can tell you, hey, wire money to Nicholas in California, or whatever that futures or commission house is. And then be able to have access to funds, because one futures contract today, it's very close to $100,000. And you can control that futures contract with only $9,000. So, the deposit about 7 to 9%. And it has gone up quite a bit. Before July 20th, it was 4,000. But what happened? We had a freeze. Market exploded. Prices went through the roof. Volatility went. So what does the exchange do? Whenever volatility gets really bad and risk goes up, they need to increase those deposits to make sure that everybody meets their obligations. If not, it would be today 3-4%, $4,000, which is not bad.
Can we dive into that freeze a little bit? Because there's a lot of information
Sure.
out there, and it's a little bit controversial in some sense. So I would like to analyze it a little bit on different levels. So one you just mentioned on the pure data and information level, like what is really happening, and how does that translate into that I would say hype or that stress maybe some people feel.
Well, you hit one of the words, controversial. You mentioned that word. And here, let me take you a little bit of history of coffee and logistics, supply and demand numbers. And I'm a big critic of it. If you see my presentation, I always criticize, because we're a very large business globally in terms of volume, in terms of value, in terms of how many countries we are produced, how many countries we consume. It's huge. But our logistical, our supply and demand numbers are pretty concerning. We do not have proper transparency. So you go back to the question, the volatility, the transparency, and the problem is that we don't know yet exactly how much we produce on a regular year, nor do we know how much we consume on a regular year. And it's very difficult to find out what our stocks are in a year. There's a lot of controversial. There's a lot of misinformation. We're lacking. For example, if you go to corn, the USDA publishes corn numbers every single month. The USDA and coffee publishes the coffee production number once a year.
Oh.
So that lack of information creates uncertainty.
Right.
That uncertainty creates volatility, and that volatility means risk. And that's the problem we have in coffee. We have a huge amount of volatility. So, for example, we have a total of 80 countries that produce coffee. Really, 60 are listed, and really about 40 generate the coffee, of which approximately 15 generate about 80-90% of the coffee volume. And there's a lot of misinformation out there. And what do a lot of the country governments publish as their production numbers? They tend to send them low. Why? Because obviously you want to
bring the price up.
Bring the price up. And then when you look at consumption numbers, we really don't have reliable consumption numbers. Let me give you a little bit of some of the things that we always argue. And it'll go to your question, well, how much did it get damaged in this freeze? Normally, we spend months and months. The flowering, for example, in Brazil happens between September 15 and October 15. Usually you get 4 or 5 flowerings, right? That's going to be the flowering for the harvest that starts in April to July next year. So we'll get the flowering. It'll go months, everybody putting on numbers, high, low, medium numbers everywhere. It'll take us months to figure out what is the harvest on a crop that has already flowered, already growing, already granulating, weeks away from harvest. We still don't know. Yet the market wanted to know within 23 minutes of the freeze how many bags to the bean were damaged on a harvest that still hasn't flowered or still hasn't shown any beans. And that's the problem.
Right.
Directed to the question that what is the volatility? What is the arguments out there? It's very complicated. So let's go to July 20th of a few weeks ago. Coffee, what affects all agricultural commodities are 3 things. The volatility of agricultural commodities come from weather, global macroeconomic conditions, and supply and demand. How much you produce, how much you consume, what's left over, stocks. In coffee, the big black swan event is weather in Brazil, which is 40% of the world crop. So you can have either a freeze in a winter month, which is the opposite of the northern hemisphere. That's southern hemisphere.
Right.
It's May, June, July. And the second is drought, which is normally, historically, has always been between September and October. That's when the rainy season comes, and you need the rains at the right time and continuous rain to not only spark the flowering, but also to hold the flowering. As of 2014, we found out that there was a second drought event, possibly January and February. And those were the 2 big droughts, 2014 in Arabica, 2015 in Robusta, Conilons, as they're called in Brazil. So everybody always bet on the freeze, because the freeze would hit you overnight. You wake up, Brazil has been destroyed, the harvest, market doubles or triples in price, everybody's dream in the rest of the world, all the other producers' dream come true, market prices double or triple overnight. So we had a freeze around the 15th of the month, July, very light. You always get these cold fronts coming in. The first one was very light. The talk was about 100,000 bags. But then July 20th, we had another cold front coming in. I remember July 19th, the market fell 600.6 cents a bag. And it wasn't really showing much, that cold front. But lo and behold, it really shocked everybody. Temperatures dropped more than expected. As a matter of fact, it was snowing in 14 cities in Brazil. It started snowing because of the high winds and the low humidity. It allowed for the freeze that nobody was expecting, and prices exploded. And then on the 28th, 29th, we had a third cold front that weather forecasters were saying that it was going to be even worse than the week before. And the market just went through the roof. But what happened, that third probable freeze never really materialized because humidity went through the roof and the winds calmed down.
Mm-hmm.
So it's a whole bunch of variables that can affect a freeze, whether it's temperature, the dew point, humidity, wind, the whole thing. So the question is, how much damage did it occur? Impossible to accurately say.
Mm-hmm.
What is our number? We have an ags team, and we're going to go again. To really get an idea, you need to wait a little longer to see how the plants, the plantations responded to that aggressive cold. It takes several days, maybe a couple of weeks for the plant to talk to you.
Mm-hmm.
The initial numbers that keep going around is 165,000 to 175,000 hectares.
Mm-hmm.
Then you got to tell what was the productivity on each hectare. So multiply that by whatever the number is.
Mm-hmm.
So we go from the ranges of the low ranges of 2 million bags all the way to 10 million bags. And again, we go to that same uncertainty that we run every year in the normal production estimates, which this past year, from the low to the high, was almost 14 million bag difference.
That's amazing, Albert. So you were mentioning we are in the information age, well into the information age, not just starting.
Right.
We have all this connectivity, we have all the systems, and I tell you that because 20 years ago I started working in Colombia on information systems for farmers. One of the stuff we were working on, because we were focusing on smallhold farmers, was more like precision agriculture concepts and those things. So why is there no, let's say, national interest, for example, or some associations to actually put systems in place? Because in terms of software, it's out there. And I mean, Cropster has some of it, but not all of it. But I know that there's many other vendors who would be gladly equipping every farmer with a phone or with an app. What is holding back?
Well, number one is money.
Mm-hmm.
Honestly, number one is money. For example, if you look at the farming of wheat or corn or soybeans, as the farmer is harvesting, the combine, the harvesting machine, is telling you how many bushels per acre you're live harvesting.
Right.
The information, then again, you're looking at the United States Department of Agriculture and the U.S. government behind the push. Mm-hmm. Then in Brazil, you have pretty much the same. In Argentina, huge. Mm-hmm. In coffee, we have a deficiency. We just have a deficiency. The biggest producer in the world, Brazil, has the CONAB national production estimate of the government, which they tend to go low, and everybody knows it. So if CONAB comes with a number, no matter if it's low or high, the market shrugs it off. Why? Because of the history that they've had. Mm-hmm. Then you have Vietnam. Then you have Indonesia. Indonesia has a lot of question marks on their production and inventory, not just in coffee, but in cocoa and palm oil, mm-hmm. Several. You have to look at, you have 10,000 islands in Indonesia. So is it a matter of that there's not enough resources to, conduct accurate numbers? Then you have Vietnam, the second producer in the world. Most of the coffee is also government controlled. So, you see where I'm going.
Yeah.
Sometimes the question is the lack of ability to have a system in place. Is it money, or is it massaging the numbers? And historically, if you go back 150 years of coffee, massaging the numbers tends to come up quite a bit. And I've spoken to many people who used to work at the old Brazilian the IBC, what's it called, the Brazilian Institute of Coffee, mm-hmm. and they said, Nicholas, our head agronomist, says is 60 million. Let's put 58.9. Sounds better. Mm-hmm. And that goes in coffee, whether you want to accept it or not. And then on top of that, you have consumption. If we have tens of thousands of agronomers globally trying to count beans and we still get it wrong, and this year we had a difference of almost 8 million bags into the harvest. Mm-hmm. Well, who's counting how many cups you're drinking? There is no agronomist. There is no institution. So we go by the disappearance formula, which is, okay, how much you produce, how much you import and export, and how much stocks are left. Whatever is missing is consumption. But if you don't know what production is and you don't have the stock numbers, your consumption number is going to be wrong. So that is the bulk that we have. And that's one of the things that we're pushing mostly in just about in every speech or event that we speak at, is that the world of coffee needs to set up a new, different system in place.
You speak my soul and my mind, and of course, this is what we do, right? In technology and systems. Where do you think that investment could or should come from?
The actually producing countries. There's a big argument, okay, who should do it, the consuming countries or the producing countries? And what I'm telling now the producing countries is that the producing countries need to take the lead to get the numbers right, not only to get the numbers right, but more importantly, is to set up a consumption promotion system in place.
For their own, in their own countries. Or globally.
Especially globally, but my last speech with Dana Cafe, and I can share the presentation with you. The biggest growth potential that we have globally for the benefit of coffee producers is in the own producing countries. That's where the biggest growth we can see.
Right.
But if you look at many countries, is produce and export it, get it out of here. And many of these countries have the best coffee in the world, yet they don't want to consume it. No, sell it, get it out.
Yeah.
And the biggest growth that we can have in consumption is in producing countries.
So there's a little bit a conflict here, as you said. Some countries might not be actually interested in measuring all the data or having those systems in place. How strong is that influence, or what would be an argument against it to say, well, get better data because you hedge better, or you trade better, or you get a better position on the table? I don't know.
It's much simpler than that. Let's say we go to a country, just make up a country. We'll go to a country and we'll say, okay, we got to do this. First question is, who's going to pay for it?
Right.
And then you say, well, Nicholas, you're the producer. Why don't you, I'm not going to put it in, because if Norbert doesn't put it in, I'm not going to put it in. And Norbert's going to say, well, if Albert doesn't put it in, and then we go in a circle again.
Right.
We go in a circle again. For the last several years, there was a questionable call on the Brazil's CONAB that their numbers were just off. And it got to the point that they said, okay, well, there was unconfirmed reports that the CONAB contacted the USDA to hire them. Hey, come and teach us, come and show us, how do you do this? Satellites, how do we, talk about technology? We have technology. But the cost was $14 million, to the whole thing. But how big is coffee in terms of dollar? Yeah, 14 million is a lot, but how big is coffee? And then the politics say, well, if we don't pay 14 million to the USDA, we can do it here locally, blah, blah, blah. And, the politics start getting the whole involved. And that's, okay, next chapter. And then we keep going. The same things that we see today, this is a repeat of 30 years ago. This is nothing different.
So we need to disrupt the system somehow different, right? By getting directly to the farmers, for example, and influencing or incentivizing them to count their own beans.
And now is the best opportunity. See, you want to invest when there's money. You don't want to invest when the things is at 98 cents a pound coffee. Your cost of production is $1.20. You're barely trying to survive. You don't want to invest when times are bad, because there is no money. Now we do have, for example, Brazil. The internal coffee prices in Brazil is, I would say, double the historic highs. Colombia's internal prices very close to double historic highs. Most of the countries are enjoying historically high prices because of the currency devaluation, not because coffee is at the historic high. It's a combination of New York prices, but more importantly, currency devaluation. So now there is money, especially for, if you're in Colombia, there's good Colombian in income right now to be able to invest in consumption, to be able to invest in, what you mentioned, technology. This is the time when there's money. We need to invest for the future.
Like what you've heard so far? This podcast is brought to you by Cropster, a software solution that connects coffee professionals from origin to roasteries and cafes around the world. Whether you produce, trade, roast, or brew coffee, Cropster products will help your business take that next step.
So those great prices might not last forever. So they might go down at some point. What is the triggering event for that?
Okay, so historically, you just said what happens. If you go back 50 years, whenever we have a freeze or a drought, we have the big spike in prices. Prices explode, but they last very little up there. They don't last long. And immediately, what happens when you have these massive price spikes? Well, if you're a producer, if you're a farmer, what do? Well, let me buy the neighbor's farm, because now I'm making so much more money in coffee. Let me expand my production. Now I can put more fertilizer. Now I can invest more in husbandry. Now I can make this thing really produce. And then you also have, Nicholas, who's a lawyer in XYZ country, say, hey, I hear prices in coffee are historic highs. Let me invest in coffee production. So normally what happens when you have these massive price spikes is that crops globally explode. This is not, it's happened 6 times in the past 50 years. Now, your question is, when does that happen? Look what happened in the last frost. Market went to $2.16. We're trading $1.80 today. That happened 2 weeks ago.
So it goes already down.
Yeah, it's down. So in 2-3 weeks, you could say that the market has lost almost 35 cents.
Okay.
And that's a considerable amount. That's 15%.
Right.
What is the next big thing that we need to watch as members of this coffee supply chain, from the producer to the final roasters and coffee shops? We still don't know what the exact number is on damages from the frost. Our unofficial number is somewhere between 4 or 5 million bags. But we still have to go out and do several trips. I'm going to go personally with the team, possibly end of October. Right after the flowering, right after you start getting the flowering has happened, and you start getting the baby beans start growing, what they call the chumbinos, to get a better idea. The next thing we need to watch, and we are watching every day now, I don't know if Nicholas, you're getting my messages, is the rainfall. We've gone already through 2 years of La Nina. Last year, the reason our crop went down in Brazil 20%, 21.2%, was because last year the world got hit with a pretty strong La Nina, which basically decimated crops across the globe, from soybeans to soybean oil to canola to colza in Europe to palm oil in Southeast Asia, and coffee, because La Nina in the Americas brings high heat and drought. We had massive heat in the Midwest in the United States that brought down tremendously the soybean crop and the canola oil crops. And as well as in Brazil, it brought droughts. Everything went up: corn, soybean, sugar, and coffee. We're going into another year with a high probability of La Nina. Still not confirmed. We're still watching the temperatures out in the Pacific. So if we get another bout of La Nina, well, what's going to happen? We're going to get another drop in rainfall. And the important window that we need to watch is September 15th to October 15th. Rains need to come in during that period in order to spark the flowering, sustain the flowering, and feed the new beans. And that's going to be the determinant factor of, okay, what's next year's crop? Is it going to be good? Is it going to be high? Is it going to be low? How much are we going to recover? Because next year is the high cycle of the Brazilian crop.
Right.
So we're going to watch that flowering and how the rains continue to come. Because if they come, flower sparks, and then we have drought, forget it. It's over.
So there might be another price spike coming, or not?
Depending on the weather.
Depending on the weather, right? So you were saying those effects last quite short. Who can take advantage of it? So how does this translate to small or mid-sized farmers? Can they actually sell at those high prices? Is this something they can participate? or is this watered down because there's so many middlemen and middlewomen? And
no, for example, we have a lot of small farmers. Certainly all the co-ops have the access to the commodity futures markets. They have access to the prices. You can sell December, you can sell March of next year, May. In coffee, you can hedge and fix prices 3 years forward.
Yeah.
So if you're a farmer, and many farmers, for example, in Brazil, what they do is they'll look at this year's harvest, but they'll also look at next year's harvest. All right, let me sell 40% of next year. And then the second year, what are the price? Okay, let me sell 10%. So as a farmer, you can go 1, 2, 3 years out and do a portion so you can guarantee at least some of that price. And today we have good prices. For example, let's say Colombia, $1.80. Then you have an extra 52 cents of differential. And then on top of that, you have a very high exchange rate. So internal coffee prices today are 1.7 million pesos per load. If you go to Brazil, you're talking 1,100 reais per bag. And the producer can, hedge long term. Now, one problem that has arisen in the last 6 months with this tremendous price rally is that you do have concerns of defaults on behalf of the producer, that maybe last February you sold at what you thought was the historic high price, and now it's even higher. You say, you know what, Nicholas, I'm not going to deliver coffee at the price that we prearranged because I'm going to sell it to somebody else at a higher price. But you agreed to deliver to Nicholas, and he took all those, hedges, and he sold the coffee. So there's a supply situation right now with possible defaults. So what keeps you from doing it? Really not much. You do have to meet your obligations, that if you sell that coffee, you need to meet the obligation. If not, the exchange will call you for the margin deposits.
Right.
But everybody has access or can have access.
Right. So the reality is that those co-ops will benefit from those high prices because they're part of that game or that system.
Yeah, the co-op works on behalf of the producers.
Right.
The co-op has its members, and the members, the purpose of a cooperative agreement is that few help many. Yeah. So all the producers are part of this co-op. The co-op provides all the services that, for example, a multinational could, and they provide, hedging tools. They can provide selling, transport, all the benefits that a cooperative agreement can provide all its associates.
Right.
So I can imagine given that this is this is the financial world side of it. I'm curious to know what some of the legal implications could be of a producer in Colombia, for example, doing hedging a futures contract in the U.S. or in London. Obviously, that gets really complicated with international law and whatnot. I'm just wondering what some of the legal implications could be there.
Really, it's very simple. You're a Colombian producer or exporter, or anyone down there. You open your account and you call your broker, and you look at December prices, and December prices are attractive at $1.80. Then you add your differential, which is another 52 cents, and you do your exchange rate, so you can book a tremendous income never seen before. The implication legal, if you're directly hedging with the exchange, you're still going to deliver your coffee to your physical buyer that you always dealt with, whether it's a multinational exporter, whether it's a co-op, but you're hedging internally your risk with the market. The moment that you call your broker and you give instructions to sell one futures contract, that day the exchange requires you to post $9,000 collateral. And I think that's going to go down. Once the volatility goes by, they're going to start bringing it down. So you post your margins, and every day you have to post, the market movement, whether it's against you or if it's in favor, they'll deposit it. Let's say that the market moves and you can't send any more money tomorrow, the day after. At that moment, the broker will call you and say, Nicholas, you need to, you have a margin call, you need to post the difference. Say, no, I don't want to post anymore, or I don't want to send any more money. well, then the exchange requires the broker and the customer that you need to get out. You need to liquidate your positions. So in the futures market is very simple. The futures market, the system, the financial system is measuring your financial situation day to day. If it's a physical, in other words, you don't go to the futures market, you go directly to, I don't know, some middleman or co-op, whatever, and you agree back in March that today you're going to deliver coffee, and all of a sudden today you decide you're not to, then there's a default, and then you go in with the local laws. Let's say you're in Mexico. Okay, so what is in Mexico? Because you have contracted privately in a commercial deal with the co-op in Mexico that you're going to deliver at a certain price. Now you're not going to deliver. Okay, what is the legal implications in Mexico? How do they hold that contract, that physical contract? In the futures market, simple. We measure day to day. But in a physical, internally, you're not going to find out until 2, 3, 4, 5 months. Hey, no, I'm sorry, I can't deliver.
Right. So I also know some cases where they don't hedge anything locally. They basically produce first, and then in that producing months or weeks, they already see a little bit closer how much they will have, and then they go actually to the local representatives or co-ops or some of the big firms are directly on the ground, or in Colombia you have the Colombian Coffee Federation, of course, and they all offer prices during that week. So how do those prices reflect what's going on the hedging market right now? Let's say it is December, my friend down in Colombia produces, Nick in Colombia produces, and he says, well, I just produced 20 bags and I want to get those fantastic prices. Will that be a reality, or will that?
Yeah, if the market is still there, and what you just mentioned is the truth. The majority of coffee producers, they don't hedge.
Right.
You produce, okay, you harvest, okay, where's the price? I have the coffee here, where's the price? So when December comes around, Nick will harvest, and most likely he's got all the information. Because like I said, all producers have smartphones. They get little text messages. And for example, in Colombia, many other companies, whether it's a multinational company or co-ops or the federation, they'll send a little text message and say, today's price is blah, blah, blah. Where's that price come from? You have, and we're taking the example of Colombia, since you mentioned it. You have, all the private exporters, you have the federation, you have the co-ops, and they're all throwing prices all day long. Where does that price come from? Number one is a combination of where's New York, where is Colombian differential traded today, and where is the exchange rate today. So based on that triangle, and there's other costs because there's taxes, there's shipping from interior to the port to the mill. Right. There's a whole bunch of, but the three main are those three items in that triangle. So that combination, they put it on their Excel sheet, and it'll spit out, okay, today is 1.7 million pesos per 125 kilo load of parchment coffee. And then what happens? Okay, Nick is a big multinational. So Nick said, okay, Norbert is bidding 1.7. Okay, I'm going to bid 1.720. And then somebody else, okay, he's bidding 1.7. Okay, I'll do 1.730. So then you have the minimum price that the formula throws, but then somebody, if it's a lot of demand, the price goes up or down. But that's where the internal price is, whether it's Brazil, whether it's Colombia, whether it's Mexico, Guatemala. Those are the three main. Where's New York? Where's the differential? Where's the exchange rate?
How does the hedging come in here? So if as you say, today the price is 220, but the farm gate price might be only 150. So someone sold that coffee for 220 now.
No, so you say that today the price is 220.
Yeah, just as an example.
Just to put a okay, the price today is not 150. Today the price is exchange rate today is $1.80. Then there's a physical differential for the origin. Right. Let's say Colombia is plus 50. So whoever comes in to buy that coffee from the co-op or the producer,
Mm-hmm.
will offer based on, let's say, 230.
Mm-hmm.
Okay. If Nicholas, who's the producer, says, okay, Norbert, let's do it, then Norbert has to turn around, whatever the company, turn around, call their broker, sell one futures in New York for December. They're going to sell the differential physically with their buyer, and immediately they have to lock in the exchange rate for that delivery.
Mm-hmm.
And they take 3 shorts. You have to sell the futures in New York to guarantee that price. They have to sell the differential with the buyer,
Mm-hmm.
and then they have to sell the dollars that are going to be received. Because if you don't hedge, if anything of those move and they move against you, it's going to hurt.
Right.
So whenever the producer brings the bags of coffee to the market and Norbert offers XYZ price, Norbert has to take the hedge immediately.
Mm-hmm. Mm-hmm.
You could not take if you don't want to, you don't have to hedge. But what happens if the market collapses? You're taking a big hit.
Right. It's a very intriguing and complex situation, in my opinion. I would like to learn, of course, more. I just want to bring one kind of last example, and then maybe move on a little bit to other topics. What if I can just wait? So I'm a producer, I put things in storage, and I wait until the price is right. Is that an option? If as long as I have the financial means to sustain myself, which I know is not the case in many farming communities.
Sure. And for example, Brazil is very common. Brazil, bigger producers, they'll harvest, and out of the harvest, they'll sell 80% and keep 20 as a savings.
Mm-hmm.
So that is very typical. You hold back. Some countries hold back. Brazil holds back more than, for example, Colombia. Depends on your financial situation of the producer. Can you hold 20%? Do you have the financial capability of holding 20%? And you can hold it, save it, especially if you're in a economy where you have devaluation, because you have a product that's sold in dollars,
right?
And your currency in your country is devaluating. That's you make big money is made in devaluations if you're holding a US dollar. But then again, Norbert, you get into a situation that's called speculation.
Right.
So, okay, let me hold 20, 30%. Let me hold half because I think prices are going to go up. What if they fall?
Right.
That you get into speculative mode.
Mm-hmm. Mm. Well, and also, so then that's a little bit the segue to specialty coffee, where most of our listeners, I think, are interested. Specialty coffee doesn't get better by storing it. So we want the freshest crop on our tables and in our cups. How can we incentivize that with that hedging game or with that situation? Is there an incentive for farmers to sell as quickly as possible and for traders to release as quickly as possible?
Well, you just said the trick. As coffee ages, you start losing premium. You start losing qualities. You start losing what gave its premium price.
Mm-hmm.
And then the next question that you get in, do we need to hedge specialty coffee? Everything trades on a differential.
Mm-hmm.
So everything trades, let's say Arabica, the base is New York.
Mm-hmm.
But then, for example, Nicholas may be trading Guatemala, or I don't know, somebody else may be trading Kenya AA. Everything trades at a differential. Differential means difference of New York to your local market.
Mm-hmm.
So let's say Nicholas is a producer of Guatemala, Antigua. The differential for that coffee is much higher. Differential means difference. Difference from where? Okay, the base is New York. Where is Antigua trading? Or where is Kenya? Or, for example, you may go to other coffees such as Brazil, which are a discount to New York.
Mm-hmm.
So everything's traded based on a differential. So let's say that I want to buy Antigua, Guatemala, Antigua. Okay, that producer can hedge, or that roaster can hedge the base, which is New York. And then they just lock the differential with the supplier. So all coffees are hedged. Now, here's the next question you're probably going to ask. Fixed price coffees, right?
Mm-hmm. Right.
So let's say I want to buy Peruvians, I don't know, it's a special organic, blah, 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 coffees from here or there. No, just give me a fixed price. I don't want to talk differential, New York, whatever. Let's just say $3 a pound. right?
Mhm.
So I want to buy $3 a pound. You're going to sell me $3 a pound. Today, when the market is $1.80, it looks a great price. What happens if we get, and you and I'm the producer in Peru and you're the buyer in California, and we agree to $3, you're happy because you're the buyer of coffee in California, and I'm ecstatic because I'm the seller in Peru of this organic coffee at $3 a pound. I'm going to deliver in December, I promise you. Now, September 15th, we get the rains delayed. No rains, September 30th. October 10th, no rains. Price explodes. And then we're October 15th to October 30th, and New York goes from $1.80 to $2.50. This is hypothetical. Don't say that Albert said it's going to go to $2.50. It's a hypothetical situation I'm trying to. So now coffee's at $2. Well, when I sold you the coffee at $3, coffee was at $1.80. So what was the differential? $1.20, right? The difference. Now that the coffee is $2.50, well, me as a producer, I don't want $2.50. I want $3.70 now. And I tell you, Norbert, you know what? I can't. You have to pay me $3.70 because the market went up. And you tell me, but Albert, you promised $3 delivering. We have a contract with it. Sorry, Norbert, I can't deliver.
Right.
So doing coffees in a extremely volatile market that we live in, fixed price, very dangerous.
That's right, but it goes both ways, right? In a market where the $3 is fantastic, I can take the deal, and that might be a good deal for the farmer for like 2 or 3 years, and then come year 4, and then the price switches, and then suddenly it appears to be a bad decision for the farmer. But it's risk management ultimately. But we also sometimes explain it with like relationship coffee and direct trade to basically take the guesswork out. There's words like sustainable income or living income and those things where we get closer to reality of the farmer and say, farmer, I will always pay you what you need to live plus cut a profit. And if that is the $3, I promise that independently if price goes up or down. Why is that? I mean, I know human nature is not ultimately like that, but it could be like that. So what do you say about it? Is it like a hippie concept? And it's like, oh yeah, this is great for that 0.7% or not even.
And it happens. Right now the biggest concern that we have in the industry is that prices have spiked so fast that everybody's concerned with those agreements that we made last year.
Right, of course.
Now, so how do we fix it? Because you mentioned, what's the hedging? So how do we fix it? Let's go back to the deal of the $3 of Peruvian organic, and you're the buyer in California. Before this whole mess of the drought or freeze or whatever, and you contracted with me Peruvian for the next 2 years. Okay, $3. Okay, we have coffee is very susceptible to weather. You can insure that price. Okay, so me as a producer, I'm making a great deal here, $3 a pound. Coffee's at $1.80. You as a consumer, you really want my coffee because I have a really special coffee that you need for your cup, for your roasting.
That's right.
There's something called insurance in the prices of coffee. In the financial markets, we call them options. So, for example, as a producer, I can say, I'm going to sell this gentleman the coffee at $3. But if there's a freeze or a drought, I can insure myself. So I'm going to buy insurance at $3 so that if it goes to $5, I'm going to make a killing. And why do you buy insurance on a car? Because the first thing you do when you buy a car, before you take it out of the dealership, you call the insurance agent. Make sure it's fully insured.
Because it's a legal requirement.
Well, not necessarily, because
on the car, okay. So liability is legal requirement, but not on the car.
Yeah, but not on the car. You could just buy the car and just walk out.
Right.
But if you have an accident, the moment you drive out and you have an accident, it's your equity. It's your loss.
Right.
So what does everybody do? We buy insurance. And we have that already, burned into our DNA that whatever we have risk, we buy insurance. Question is, why are we not doing it in coffee prices? And the majority do not do it. If you're a roaster, if you're a producer, you can do your contracts and put a little insurance to guarantee that if worst case scenario, if there's an accident, you have a price insurance. So then we get into the second instrument, which you can do the futures price, or you can do the options, the insurance price. And many times we do, for example, those roasters that want to have that relationship coffee that you mentioned, that sustainability and for the farmers and all that. And let's say coffee prices are $1, and you tell me, look, Albert, I'm going to pay you $2 for the next 3 years. But you always have that risk that if prices explode, you may not get delivered. So what do? You put an insurance at $2 coffee. So the worst case scenario, and it's very cheap when you're talking those levels far away, it's very cheap, and you can guarantee for the worst case scenario. And you tell the producer, I'm going to pay you $2, and if it goes to $4, I'll raise it to $4.
Because of that insurance.
Because of the insurance. So there's a lot of things that we can do in terms of hedging, even if it's specialty, even if it's a fixed price that I'm going to pay you $4 a pound for forever and a day. There's always that question mark. And what do you do December 31st when the insurance expires? You call your car insurance broker and tell them renew. You don't even argue because they may raise prices, right? So January 1st, you renew automatically. We don't have that, burnt into our DNA in the coffee world.
Okay, so there's a lot of education still needed, and I can see, and that's part of why we are talking here. And I appreciate your time and all your insights. This is really very valuable, and I feel like we'll get some questions here from after this publishes, and because it I think there's a lot of people still intimidated, including me, by financial markets and risks. And sometimes the answer is, oh, this is too complicated. I would rather not engage and walk away instead of doing something. So what is the something where people, and I got a feeling that the insurance might be the first step, not the hedging. What is your take, Albert? If people buy or sell coffees, should they first think about insurance to not get overwhelmed, or should they just talk to brokers and say, hey, if you don't want to deal with that, it's like with the bank. You go to the bank, put your money there, and they will find a deal for you. What is your advice?
And you mentioned we brokers in the financial industry, we have, we tend to complicate things. And we tend to put very complex names to things. What we've done in StoneX is try to, get away from that. So, for example, when we do some of these strategies, the industry calls them really complex names. For example, one of the strategies we have is variable sales. All producers know how to do fixed sales. Variable sale is where a producer sells, but if the market continues to go up, they can continue to increase their prices. The same with roasters. Let's say I'm paying $1.80 for coffee. That's very high. A roaster can buy fixed price and protect and do variable purchases. Okay, I bought it, but I bought an insurance. So if it collapses, I never bought it up there. I can break it down. But in order to understand this whole world of hedging and financial things, the best thing is to take classes. We used to do 4 or 5 times a year. We do hedge shops, hedge workshops. Unfortunately, because of the pandemic, this whole thing, we haven't been able to carry these on. And online, these are very complex, 3-day, 21-hour sessions. So it's very complex to do them online. But the first thing that we need to do is transmit these through, simple workshops, so that at least all the stakeholders can say, okay, there's something out there called hedging, and you can do this and you can do that. And if I need more information, let me call one of the brokers in the industry to get more explanation on it. But the way to do it, the way we've done with all of our clientele, is through workshops, teaching simple concepts, little by little.
Right. So, and if a coffee roaster is committed to this, let's say, the social good, knowing that there's certain costs at origin, and want to guarantee that the producer gets paid well, what is their element? So they don't want to hedge down. They don't want to get into the, let's say, negative betting. They just want to guarantee certain prices. Is that possible? Can that be done?
Yeah, sure. There's different ways of cutting the cake. There's different ways of splitting the atom here. A producer can come in and say, okay, coffee's at $1.80. My cost of production, New York, let's say it's $1.30. Okay, because I know I'm going to get paid 50 cents differential. Okay, but my base is $1.30 for New York. I can come in and buy insurance at $1.30, let's say for March of next year.
Mm-hmm.
And because it's so far away, it's going to be cheap.
Mm-hmm.
So if the market all of a sudden collapses and goes to $1,
right.
Well, I have this insurance that the exchange guarantees me $1.30, and I sold it to Nicola's exporting company at a 50-cent over premium. Mm-hmm. So I'm back to $1.80 with the market is $1. So you can go simple or you can go more complex. The amount of instruments that the exchange provides and strategies are, quite deep. But at the very simple, just like you buy the car insurance, you can also buy price insurance in case it crashes.
So knowing that farmers are always cash strapped, if a roaster wants to do that for them, so let's say, hey, I want to help my farmers and I will pick up the insurance tab. Is that a possibility?
Absolutely, and we do that every day.
Okay.
We do that. There's a lot of, for example, roasters that have, the social programs, relationships. And okay, the farmer may not have the financial ability to do all this. Well, the roaster says, I have the accounts, I have the systems. You tell me what you need. I know you don't sell me the coffee, so I'll provide you in the meantime from here until March that you deliver the coffee, provide you the tools for you to protect yourself. Because I want you to do good. Because if you do good, I'm going to get really good quality coffee.
Right, exactly. And for you, Albert, and your company, it's all the same. So whatever the market needs, you're there to provide those tools and those instruments. There's no like either or a certain direction you need to go.
No, we have customers go directly from very small farmers in the producing countries all the way to coffee shops destination, and then anyone in between.
That's really powerful. I think that's extremely exciting. Yeah. So that basically one of the messages can be, hey, roasters out there who want to do good and wanna go that route, call Albert and tell him what you need and what you want, and Albert makes it happen.
Absolutely.
That's fantastic. I'm excited.
Excellent. And there's a lot of more information. If you want to do another podcast or and get a group of producers or roasters, so we can have I'll be more than happy to do that. I'm sure they're going to get a lot of benefits, especially now. There's so much, volatility, uncertainty, things to try to figure out and understand.
Yeah, no, and this is nice because I think for a very, your field of work is very complex and can be complicated, but you were able to simplify it for a lot of our listeners in a way which is going to be massively beneficial. And honestly, it probably will call for some follow-ups.
Absolutely. Be my guest.
Yeah, some good conversation. Yeah.
I got a great taste and I would like to continue. Yes.
Definitely. Absolutely. Let's do it again. It's been fun.
Yeah. Absolutely. Thanks a lot, Albert. I really appreciate
all right, my
insight,
pleasure.
Man. It was great.
And good luck to everybody.
Thank you.
Thank you. Thanks for listening to this episode of the Coffee and Technology Podcast brought to you by Cropster. If you enjoyed what you heard, please subscribe or give us a follow on any of our channels to always get the latest episode. If you're interested in more educational content on all things coffee and tech, be sure to head to cropster.com/learn or visit our YouTube channel. Cheers to more coffee.